The most dangerous belief in retirement is that once Social Security deposits money into your bank account, that amount is final and cannot be touched. It is not always final. Under the rules in effect now, an official notice saying that you were paid too much can become a countdown. If the notice is not handled correctly, Social Security can begin withholding up to 50% of a regular Social Security benefit to recover the amount it says you owe. A monthly payment of $2,240 can suddenly fall to $1,120. Rent does not fall by half. The electric bill does not fall by half. Prescription costs do not fall by half. But the money arriving in the account can. That is why an envelope that looks routine can be more important than a bank statement, a credit card bill, or even a tax notice. Stay with me through this entire explanation, because near the end I will show you the protection most people miss. The action that can stop collection while the dispute is being reviewed. The form that can lower the amount taken each month. And the difference between saying, "I cannot pay," and making the legal request that Social Security is required to consider. Nobody is going to place this protection in your hands automatically. You have to claim it. I have spent decades studying the way retirement income, taxes, Medicare premiums, bank records, and federal benefit rules fit together. The pattern is almost always the same. People do not lose money because they are careless or dishonest. They lose money because they believe one government office already knows what another office knows, because they assume a bank change will be communicated everywhere, or because they read the first page of a notice and never reach the part explaining their rights. A retired teacher receives a letter filled with dates and numbers. A veteran sees the words overpayment and assumes the decision is final. A widow notices that her deposit is smaller and thinks Medicare simply went up again. A part-time worker believes that because taxes came out of every paycheck, Social Security must already have adjusted everything. Those beliefs are understandable, they are also expensive. Pay close attention to this. The title of a notice may sound administrative, but the notice is not merely information. It can be the first step in a collection process. A real Social Security overpayment notice should explain why the agency believes too much money was paid, the amount it says is owed, how it plans to recover the money, and the person's rights to appeal, request a waiver, or ask for a different recovery rate. Those are 3 different doors. Most people see only one door: pay the full amount. That is the first major mistake. An appeal says the decision itself is wrong. Perhaps the earnings amount is incorrect. Perhaps the dates are wrong. Perhaps the agency counted wages that belonged to someone else. Perhaps it treated a payment as work income when it should not have. The formal request is generally made with Form SSA 561, Request for Reconsideration. A waiver is different. A waiver says that even if the amount was technically overpaid, the person was not at fault, and recovery would be unfair or would create financial hardship. That request is generally made with Form SSA 632BK. A request for a lower amount to be taken each month is different again. That is where Form SSA 634 can matter. It asks Social Security to look at necessary living expenses and reduce the monthly recovery amount because the proposed withholding would leave too little for food, housing, utilities, medical care, and other basic needs. Here is what almost nobody understands. Saying the words on the telephone is not the same as making the right request in the right way. Calling and saying, "This is wrong," may begin a conversation, but it is not a substitute for confirming that an appeal was actually filed. Calling and saying, "I cannot afford this," is not the same as confirming that a waiver request or lower rate request is in the record. A person can have a sincere conversation with a representative, hang up feeling relieved, and still discover later that no formal protection was active. This is not because every employee is trying to harm anyone. It is because large systems operate through coded actions, deadlines, forms, and case records. The computer does not hear fear in a person's voice. It sees whether a request was entered, what date it was entered, and what category it was placed under. Under current Social Security guidance, the agency waits at least 30 days after sending an overpayment notice before it begins collecting. If a person asks for a waiver or files an appeal within that first 30-day period, collection generally does not begin while the request is being decided. The broader appeal deadline is generally 60 days after the person receives the notice, but waiting until day 55 can be financially different from acting before day 30. That difference is not automatic. Most people think they do not qualify for protection because they do not understand that the deadline for stopping immediate collection and the deadline for preserving an appeal are not the same practical moment. Imagine a retired machinist named Robert. This is a realistic composite example, not a description of one specific client. Robert is 67 and receives $2,180 per month. He opens a letter saying Social Security believes he was overpaid $8,700 during an earlier period. He is angry, frightened, and embarrassed. He puts the letter in a drawer because his daughter is visiting and he does not want to worry her. 10 days pass, then 20. On day 34, he calls. By then, the collection process may already be moving. If 50% is withheld, his next payment could be about $1,090 instead of $2,180. Robert did not lose the right to challenge the decision merely because 30 days passed, but he lost the safest window for preventing the first automatic reduction before it began. That is the kind of silent mistake that can cost a family an entire month of stability. Now watch how this works behind the scenes. Social Security calculates benefits from earnings records, claim dates, family relationships, age, and other eligibility information. Employers send wage information. Self-employed people report business income through tax returns. Medicare premiums can be taken from the Social Security payment. Federal tax withholding can also be taken from the payment if the beneficiary requests it. Court-ordered obligations, certain federal debts, and benefit overpayments may affect money that otherwise would have arrived. The bank sees the final deposit. The bank does not explain every federal calculation that occurred before that deposit was created. When someone looks only at the bank app, all of those separate decisions appear as one number. That is why the first rule of protecting a monthly benefit is simple. Compare the gross benefit with the net deposit. The gross benefit is the amount before Medicare premiums, tax withholding, or other deductions. The net deposit is the money that actually reaches the bank. If the net amount changes, do not assume the gross benefit changed. A person might receive a cost of living increase while the deposit rises only a little because the Medicare Part B premium also increased. Another person might see the gross benefit remain the same while the deposit falls because a new tax withholding election began. Another might see a major reduction because of an overpayment recovery. 3 people can have the same bank result and 3 completely different causes. For 2026, Social Security benefits received a 2.8% cost of living adjustment. The agency said the average retirement benefit would rise by about $56 per month. At the same time, the standard Medicare Part B premium rose from $180 in 2025 to $290 in 2026, an increase of $17.90. So, a person whose gross benefit increased by roughly $56 might see only about $38.10 of that increase before any tax withholding, higher income Medicare charge, insurance premium, or debt recovery is considered. This is not a trick. It is the arithmetic of several programs touching the same payment. But if nobody explains the arithmetic, the retiree feels as if money disappeared. The Federal Reserve does not set your Social Security benefit. Credit card companies do not calculate your cost of living adjustment. Your credit score does not determine your retirement check. Those distinctions matter. The Social Security cost of living adjustment is tied to a federal inflation measure. The Federal Reserve influences interest rates in the broader economy. Banks use market rates, risk models, and credit information when they price loans and credit cards. Medicare uses its own rules for premiums. The IRS applies tax law. These are separate systems, but they meet inside the same household budget. When rates stay high, a retiree may earn more interest in a savings account, but also pay more on a variable rate credit card. When inflation pushes prices higher, a cost of living adjustment may raise the gross benefit, but Medicare and insurance costs may also rise. When a large certificate of deposit matures, the interest can increase taxable income. When taxable income rises, Medicare premiums in a later year can rise. The systems are separate, but the consequences arrive at the same kitchen table. The first great revelation is this: the danger is not one agency secretly taking money. The danger is timing. One system acts on information from an earlier month or an earlier tax year. Another system changes a deduction now. A third system sends a notice with a deadline. The retiree sees only the final deposit and assumes the pieces will correct themselves. They often do not. This is not automatic. You have to claim the correction, report the change, or challenge the decision. Consider the earnings test, because this is one of the most common ways a person can be paid too much without realizing it. In 2026, a person who is under full retirement age for the entire year can earn up to $24,280 in wages or net earnings from self-employment before the retirement earnings test begins to reduce benefits. Above that limit, Social Security generally withholds $1 in benefits for every $2 earned over the limit. For someone who reaches full retirement age during 2026, the higher limit is $65,160 for earnings in the months before the month full retirement age is reached, and the withholding rate is generally $1 for every $3 above that limit. Beginning with the month full retirement age is reached, the earnings limit no longer applies. The phrase earnings limit causes enormous confusion. It generally refers to wages from a job and net earnings from self-employment. It does not usually mean every dollar entering a bank account. A pension is not the same as wages. Interest from a savings account is not the same as wages. A withdrawal from an IRA is not the same as wages for the retirement earnings test. Selling a house is not the same as receiving a paycheck. But these other kinds of money can still affect income taxes or Medicare premiums. This is where people mix one rule with another and make decisions based on the wrong fear. Take Linda, age 64, who receives $1,900 per month in retirement benefits and works 3 days a week at a medical office. She expects to earn $22,000 safely under the 2026 limit. Her employer asks her to cover extra shifts. By December, she earns $34,480, exactly $10,000 over the limit. Under the general formula, $5,000 in benefits may need to be withheld because it is $1 for every $2 over the limit. If Social Security knew the correct estimate early, it could withhold benefits during the year. If the estimate was too low or the wage information arrived later, the agency may later say that too much was paid. Linda may be completely honest. Taxes may have been taken from every paycheck. Her employer may have reported wages correctly, yet the timing can still create an overpayment notice. Most people never realize this. Paying payroll tax on the job does not automatically mean the retirement earnings test was adjusted in real time. The payroll system and the benefit payment system are connected by reporting, but not always at the speed of a weekly paycheck. A retiree can watch federal tax, Social Security tax, and Medicare tax come out of each paycheck and reasonably believe every federal office has already updated every calculation. That is not how the process feels in practice. Information can arrive later, be matched later, or require the beneficiary to update an estimate. A simple protective habit can prevent months of confusion. A person under full retirement age who is receiving retirement benefits and working should keep a running total of gross wages, not merely take-home pay. Gross wages are the amount before taxes, insurance, or retirement contributions are taken out. If overtime, bonuses, commissions, or extra shifts push the estimate higher, report the revised estimate rather than waiting for the annual tax form. Save proof of the report. Write down the date, the method used, the confirmation number, and the name of the representative if one is provided. A notebook on the kitchen table can be more useful than a complicated financial app when it records the one fact the system later asks you to prove. There is also a special monthly rule that can help in the first year of retirement. In 2026, a person under full retirement age for the entire year may be considered retired in a month when earnings are $2,040 or less and the person does not perform substantial services in self-employment. A person reaching full retirement age in 2026 may have a monthly amount of $5,230 for the months before full retirement age. This can matter when someone earned a high salary earlier in the year, retired in October, and then earned only a small amount in November and December. Without understanding the monthly rule, that person may assume no benefit can be paid for the entire year because annual wages were high. Most people think they do not qualify. Some do, but they have to understand which rule applies. Now move from work income to Medicare, because the second silent reduction often looks like a Social Security cut when it is not. Medicare Part B premiums are commonly taken directly from Social Security payments. In 2026, the standard monthly Part B premium is $202.90, and the annual Part B deductible is $283. Higher income beneficiaries can pay more through the income-related monthly adjustment amount, often called IRMA. For 2026, the standard premium generally applies when modified adjusted gross income is $109,000 or less for an individual filer or $218,000 or less for a married couple filing jointly. Above those amounts, the monthly premium can rise in steps. The surprise is that 2026 Medicare premiums are generally based on tax information from 2024. Think about the impact of this. A person may have earned $145,000 in 2024, retired in 2025, and now be living on $55,000 in 2026. The Medicare system may still see the older, higher income tax return. The person opens a notice showing a higher Part B or Part D charge and says, "But I do not make that money anymore." That statement may be completely true. The system is not necessarily accusing the person of anything. It is using the most recent tax information available under its process. This is where Form SSA 44 can become important. If a person had a qualifying life-changing event that reduced household income, such as work stoppage, work reduction, marriage, divorce, death of a spouse, loss of income-producing property under qualifying circumstances, loss of pension income, or an employer settlement payment, the person may ask Social Security to use a more recent estimate and reduce the income-related Medicare charge. Again, this is not automatic. Retiring does not make the old tax return disappear from the calculation by itself. The person has to claim the adjustment and provide the required evidence. Picture a couple named Thomas and Elaine. Thomas retired from a management position in late 2025. Their 2024 joint tax return showed $236,000 because it included salary, a bonus, and a large amount of investment income. In 2026, their normal household income is far lower. Their Social Security deposit is smaller than expected because the Medicare premium is higher than the standard amount. Thomas assumes the higher charge will disappear on its own when the next tax return is processed. It may eventually change, but waiting can mean paying more month after month. If retirement qualifies as a work stoppage and the evidence supports a lower income estimate, Form SSA 44 may allow the charge to be reconsidered sooner. This helps both lower-income retirees and comfortable middle-class retirees. The dollar amounts differ, but the principle is the same. The system uses the information it has until you properly give it better information. If this information is useful to you so far, leave a like. It helps this explanation reach other retirees who may be staring at the same kind of notice and not yet understand what it can do to their monthly payment. There is another layer. A one-time financial decision can create a 2-year echo. Suppose a retiree withdraws $90,000 from a traditional IRA to pay off a mortgage, help an adult child, or renovate a home. That withdrawal may be taxable income. It does not count as wages for the Social Security Retirement Earnings Test, but it can increase modified adjusted gross income. A higher tax return can later create an income-related Medicare charge. The retiree remembers the withdrawal as a one-time event. Medicare sees the tax return number used under the law. 2 years later, the monthly Social Security deposit may be lower because a larger Medicare premium is being taken out. This is why I tell people never to judge a retirement withdrawal only by the amount of cash received. A $90,000 withdrawal is not just $90,000 arriving in a checking account. It may raise federal income tax, increase the portion of Social Security benefits that becomes taxable, move the household into a higher tax bracket, and create higher Medicare premiums in a later year. It can also affect state taxes, health insurance costs before Medicare, or other income-based programs. The decision may still be correct. Paying off a high-interest debt can be wise. Repairing a roof can be necessary. Helping a child can be meaningful. But the full cost is larger than the check written that day. Now consider the tax rules on Social Security. Many retirees still believe Social Security is never taxed. That belief can create a painful bill. Federal income tax on benefits depends on what the government calls combined income. In simple terms, the calculation starts with adjusted gross income, adds tax-exempt interest, and adds 1/2 of Social Security benefits. For an individual filer, the first important base amount is $25,000. For a married couple filing jointly, it is $32,000. Depending on the total, up to 50% or up to 85% of benefits can become included in taxable income. That does not mean the government takes 85% of the benefit. It means up to 85% of the benefit may be part of the income used to calculate federal tax. That distinction is critical. Watch how easily people misunderstand this. Suppose a married couple receives $42,000 in Social Security benefits for the year, has $18,000 from a pension, and withdraws $30,000 from a traditional IRA. Half of Social Security is $21,000. Add the $18,000 pension and $30,000 IRA withdrawal, and the combined income calculation reaches $69,000 before considering tax-exempt interest or other adjustments. Part of the Social Security benefit may become taxable. The couple did not receive a letter saying, "Your IRA withdrawal will make more of your Social Security taxable." Nobody is going to tell you about this at the moment the withdrawal is requested. The IRA company processes the withdrawal. Social Security pays the benefit. The IRS later sees the tax return. A retiree can ask Social Security to withhold federal income tax from monthly benefits using Form W-4V or the agency's withholding service. The available voluntary rates are 7%, 10%, 12%, or 22%. Choosing withholding can prevent a large tax bill, but it also reduces the monthly deposit. Stopping withholding can increase the deposit, but it can create a bill later. There is no universally correct percentage. The correct choice depends on pensions, wages, IRA withdrawals, interest, dividends, filing status, deductions, and state law. This is why the bank deposit alone never tells the full story. For tax years 2025 through 2028, federal law also created an additional deduction of up to $6,000 for an eligible person age 65 or older, or up to $12,000 for a married couple filing jointly when both spouses qualify. The deduction begins to phase out when modified adjusted gross income exceeds $75,000 for a single filer or $150,000 for joint filers. This deduction can reduce taxable income, but it does not rewrite the old combined income thresholds that determine whether Social Security benefits are included in taxable income. A headline may say many seniors will pay less tax, and that can be true, but the actual result depends on the full return. Most people think a new deduction is automatic. It still has to be claimed correctly on the tax return. This is an important example of how a true statement can still mislead. Seniors get a new $6,000 deduction is true in a general sense. Every senior gets $6,000 deposited into a bank account is false. Social Security is no longer taxable for everyone is false. The deduction can lower the final tax bill for many eligible people is accurate. The difference between those sentences is the difference between education and marketing. Now let us return to the notice itself. When an official envelope arrives, do not begin by deciding whether the agency is right or wrong. Begin by identifying what kind of notice it is. Is it a cost of living notice showing a new gross benefit? Is it a Medicare income-related notice? Is it an overpayment notice? Is it a notice of planned action after work was reported? Is it a benefit verification letter? Is it a request for information? Is it a notice about a dependent, a spouse, or a survivor benefit? The first page often creates emotion. The later pages often contain the deadline, the appeal language, and the instructions that protect the person. Use a simple 4-document method. Keep the notice itself. Keep the envelope because the postmark may help establish timing. Keep proof of every fact that affects the issue, such as pay stubs, tax returns, bank records, retirement letters, medical premium notices, marriage or divorce documents, and records of earlier reports. Then, keep proof of every response sent. A fax confirmation, certified mail receipt, online submission confirmation, office receipt, or written call log can matter. This is not about building a courtroom file for every letter. It is about preventing the phrase, "We have no record that you contacted us." People watching right now may be thinking, "I use the online account, so paper does not matter." The personal My Social Security account is extremely useful. It can show benefit information, provide access to notices, allow certain address and direct deposit changes, and produce tax or benefit verification documents. But an online account does not remove the need to read. Digital delivery can create a new problem. The notice arrives as an email alert. The person assumes it is advertising, and the actual document sits unopened inside the account. Paper can be lost on a kitchen counter. Digital notices can be lost behind a password. Set a routine that is simple enough to continue. Once a month, sign in by typing the official Social Security address into the browser rather than clicking an unexpected link. Review messages and notices. Compare the listed gross monthly benefit, Medicare deductions, tax withholding, and expected payment with the bank deposit. If you help an older parent, ask for lawful authorization rather than using the parent's password. Sharing passwords creates security and record problems. A representative payee, authorized representative, power of attorney, and informal family helper are not the same thing under federal benefit rules. Direct deposit changes deserve special attention because a change can move the entire benefit, not just a small fee. Social Security strengthened identity verification for benefit claims and direct deposit changes. People who can use their personal online account can verify identity digitally. A person calling to change direct deposit may need a one-time security code from the official system. Someone unable to use the account may need to work through a Social Security office or financial institution. The reason is simple. Fraudulent direct deposit changes have been a major source of stolen benefits. Here is the hidden banking risk. A retiree closes an old checking account on Friday and assumes the new bank will handle everything. The pension is moved. The utility payments are moved. The person tells Social Security by phone but does not complete identity verification. The next benefit is sent to the old account. If the old bank rejects it, the money may return to the Treasury and have to be reissued. If the account remains open but is controlled by someone else because of fraud, the situation can become far worse. A bank account change should never be treated like changing a magazine subscription. When changing direct deposit, do not close the old account until the new deposit has been confirmed whenever it is safe and practical to keep the old account open. Verify the routing number and account number twice. Confirm whether the account is checking or savings. Use the official online account, the official telephone number, a local office, or a trusted financial institution. Do not use a number printed in an unexpected text message or email. After the change, check the official record and the bank account. This is a simple example of a rule that protects both lower-income retirees and comfortable middle-class retirees. Losing one payment can destabilize anyone when housing, insurance, and medical bills are timed around that deposit. Scammers understand the fear created by Social Security notices. They send letters that look official. They call and say a benefit will be suspended. They claim a Social Security number has been used in a crime. They promise to activate a cost of living increase. They may know a person's name, address, or part of a Social Security number. That knowledge does not make them legitimate. Social Security and its Inspector General warn that the agency will not demand immediate payment by gift card, cryptocurrency, wire transfer, cash, gold bars, or prepaid debit card. It will not threaten arrest because a person refuses to pay during a surprise call. If money is truly owed, an official notice provides payment options and appeal rights. This is where the feeling of financial surveillance needs to be understood correctly. Banks do monitor patterns for fraud, account takeover, money laundering, and unusual activity. Credit card companies use automated systems to detect transactions that do not match normal behavior. Social Security uses automated records and information matching to administer benefits. The IRS receives income reports. Medicare uses tax information for income-related premiums. But this is not one all-seeing machine judging every grocery purchase. Different institutions have different legal powers, data sources, and purposes. The practical lesson is not to become paranoid. The practical lesson is to keep records consistent and respond when a system flags a mismatch. A large cash deposit can cause a bank to ask questions. A sudden transfer to a new account can trigger fraud controls. Multiple failed login attempts can lock an online account. A new address followed by a direct deposit change can receive extra review. None of those events automatically means wrongdoing. Automated systems look for patterns because fraud often follows patterns. The problem for an honest retiree is that a protective system can delay access until identity is confirmed. That is why current contact information, secure passwords, two-step verification, and a trusted contact at the bank can be part of retirement protection. Credit score fits into this picture, but not in the way many people believe. Social Security does not reduce a retirement benefit because a credit score fell. Medicare does not charge the standard Part B premium based on a credit score. The IRS does not calculate federal income tax from a credit score. But credit score still matters because retirees may need to refinance a home, replace a car, rent an apartment, or obtain a credit card during an emergency. A missed payment caused by a reduced Social Security deposit can lower credit standing. Higher credit card balances can increase the percentage of available credit being used. Then the next emergency becomes more expensive. The benefit notice begins a chain reaction outside the benefit system. Imagine a widow named Carol who receives $1,160 per month. A $410 Medicare-related adjustment and tax withholding leave less than she expected. She places a $1,200 dental bill on a credit card with a 24% annual percentage rate. She pays only the minimum because groceries and property insurance also increased. The balance grows. Her credit utilization rises. 6 months later, her furnace fails. She applies for financing and receives a higher rate than she expected. The original issue was not just a smaller federal deposit, it became higher private borrowing costs. The Federal Reserve did not choose Carol's benefit amount, but the interest rate environment and lender pricing affect the cost of the emergency. This is why a notice should be treated as a household cash flow event. Calculate what the proposed change means for 1 month, 6 months, and 1 year. A $140 monthly reduction is $1,780 per year. A $325 monthly Medicare surcharge is $3,900 per year. A 50% recovery from a $2,400 benefit is $1,200 every month. Numbers that look small on a dense letter become real when translated into prescriptions, insurance premiums, gasoline, and food. There is a quiet emotional cost as well. Retirees often blame themselves before they understand the rule. A person who worked 40 years sees the word overpayment and hears the word fraud, even when no fraud is alleged. A widow believes she made a terrible mistake because a survivor benefit was adjusted. A former public employee feels punished because pension and Social Security rules changed over time. A man who can no longer work is afraid that asking questions will cause the agency to examine everything. That fear can freeze people during the exact period when action matters most. I want to slow this down. Receiving a notice does not make you dishonest. An overpayment can result from delayed wage information, a change in living arrangements for SSI, a family benefit change, an incorrect estimate, a duplicate payment, a delayed report, an agency error, or a misunderstanding about eligibility. The existence of a debt notice does not answer the separate questions of whether the amount is correct, whether the person was at fault, whether recovery should be waived, or whether the proposed monthly rate is affordable. Those questions have procedures. The procedure is where protection lives. The content here is educational. It does not replace advice from a qualified financial professional, attorney, tax professional, or authorized benefits specialist who can review the exact facts. But education changes the quality of the questions you ask. Instead of saying, "Why did you cut my check?" you can say, "Is this a change in my gross benefit, a Medicare deduction, federal tax withholding, or overpayment recovery?" Instead of saying, "I cannot pay," you can ask, "Should I file an appeal, request a waiver, or request a lower recovery rate?" Clear questions force the problem into the correct category. Now we reach the next rule, and it is heavier than the first. Old debts can return after years of silence. Social Security resumed using the Treasury Offset Program for certain delinquent debts after collections had been suspended during the pandemic period. This can affect federal payments such as tax refunds. The exact collection method depends on the type of debt and the benefit program, and Social Security also has internal recovery rules. The important point is that silence does not always mean a debt disappeared. A person may have moved 3 times since the original notice. The letter may have gone to an old address. The person may remember a disputed amount from 2018 and assume it was closed. Years later, a federal tax refund is smaller or missing. The person calls the IRS, but the IRS did not create the debt. The Treasury system applied an offset for a debt reported by another agency. This is another example of several systems meeting at one payment. The bank sees only the smaller deposit. The taxpayer sees only a refund that never arrived. The underlying action may have begun with an old Social Security record. Do not assume that a tax refund offset and a reduction in the monthly Social Security benefit are the same process. They are not. Do not assume that paying one small amount automatically closes every recovery channel. Confirm the balance, the debt period, the program involved, and the status of any appeal or waiver. Ask for a written explanation. If the debt is old and the person never received proper notice, raise that fact promptly and seek professional help when necessary. Dates matter. Addresses matter. Proof of earlier contact matters. Now tell me in the comments whether you already knew that acting within the first 30 days can protect the monthly payment while an overpayment dispute or waiver request is being reviewed, or whether you are hearing this rule clearly for the first time. A simple answer can help other people realize they are not the only ones confused by these notices. The retirement account cycle is where many comfortable middle-class families are caught. They do not consider themselves wealthy. They have a paid-off or nearly paid-off home, a 401k, perhaps a pension, and Social Security. On paper, they look secure. In practice, one large withdrawal can push several systems at once. The 401k company may warn about income tax withholding, but it does not calculate the future Medicare premium. The bank receiving the money does not calculate how much Social Security will become taxable. The tax software records the distribution, but it does not sit at the kitchen table and explain what the 2028 Medicare notice may look like because of a 2026 withdrawal. Suppose Michael and Susan have $620,000 combined in traditional retirement accounts. Their normal annual income consists of $48,000 in Social Security and a $24,000 pension. They decide to withdraw $110,000 to help two children with home down payments. The withdrawal is generous, legal, and understandable. But most or all of the taxable distribution may be added to income. More of their Social Security may become taxable. Their modified adjusted gross income may cross a Medicare threshold used in a later year. The gift itself may require a gift tax return depending on the amount given to each person and the annual exclusion in effect, even though filing a gift tax return does not necessarily mean gift tax is owed. One financial act creates tax, Medicare, and record-keeping questions. A Roth IRA works differently. Qualified Roth withdrawals generally do not increase taxable income the way traditional IRA withdrawals do. That can make Roth money useful for controlling taxable income in retirement. But Roth does not mean every withdrawal in every situation is automatically tax-free. The age of the account, the type of money withdrawn, whether the withdrawal is qualified, and whether the account was inherited can matter. Most people think they do not qualify for a planning strategy because they are not rich. In reality, controlling which account supplies a large expense can help a retired couple with $150,000 just as much as a couple with $1.5 million. Inherited retirement accounts create another trap. Many non-spouse beneficiaries are subject to a 10-year rule requiring the inherited account to be emptied by the end of the 10th year after the owner's death, with additional distribution requirements sometimes applying during those years depending on the facts. A child inherits a parent's traditional IRA, leaves the money untouched for 9 years, and then discovers that a very large taxable withdrawal may be required in the 10th year. The child may still be working. The distribution can fall on top of salary, push income higher, and create a larger tax bill. If the beneficiary is already on Medicare, it may also create a later IRMAA increase. Inheritance taxes are often discussed carelessly. The federal estate tax applies only to estates above a high federal exclusion amount, which is $15 million for deaths in 2026 under current federal rules. Most families will never owe federal estate tax. But that does not mean every inheritance is tax-free in every way. Inherited traditional retirement accounts can produce income tax when money is withdrawn. A few states have estate or inheritance taxes under their own rules. Property can have basis rules. An inherited house, brokerage account, annuity, or retirement account can each be treated differently. The phrase, "I inherited $200,000" does not tell you the tax result. This matters to Social Security because people often ask the wrong question. They ask, will an inheritance reduce my retirement benefit? A normal inheritance does not count as wages under the retirement earnings test, so it does not reduce a regular retirement benefit the way excess wages before full retirement age can. But inherited money can produce taxable interest, dividends, capital gains, or retirement account distributions. Those amounts can affect taxes and Medicare premiums. For SSI, which is a needs-based program, an inheritance can affect eligibility because income and resource rules are different. The same word, inheritance, can have very different consequences depending on which benefit a person receives. This is one reason notices feel unfair. The person hears Social Security and assumes one set of rules applies to every monthly payment. Retirement insurance benefits, disability insurance benefits, survivor benefits, dependent benefits, and supplemental security income are not the same program. SSI is based on financial need and has income, resource, and living arrangement rules. Regular retirement benefits are based primarily on covered earnings and claiming rules. An action that has little effect on one program can have a major effect on another. A woman receiving SSI moves into her daughter's home and stops paying her old rent. She thinks the move is a private family matter. Under SSI rules, living arrangements and support can affect payment. A retiree receiving a regular Social Security retirement benefit moves into the same daughter's home, and the move itself usually does not reduce the retirement benefit merely because rent changed. The bank deposit may be called Social Security in both households, but the rules are not identical. Failing to identify the program on the notice is like reading directions for the wrong medication. Automated information matching makes these differences more important, not less. Employers report wages. Financial institutions report certain interest and other tax information. Government agencies exchange authorized data for program administration. Social Security expanded payroll information exchange processes to reduce improper payments. Automated tools can compare reported information with records and flag differences for review. Social Security has also announced artificial intelligence enhancements for certain hearing recordings. None of this means a machine secretly decides every case without human rights or appeal procedures. It means the first sign of a mismatch may be generated by a system long before a person understands what caused it. Watch how this works in ordinary life. A beneficiary reports that part-time work ended in March. The employer later reports wages paid in April because the final paycheck included unused vacation. The system sees wages after the reported stop date. A notice is generated. The beneficiary says, "I did not work in April." That may be true, but money was paid in April. The correct answer may depend on when wages were earned, when they were paid, and which rule applies. A pay stub and employer letter can resolve what a telephone explanation cannot. Or consider self-employment. A retired contractor says he earned $18,000 from a small repair business. He is thinking about the cash left after buying tools, gasoline, and materials. Social Security may need net earnings from self-employment under tax rules, not the amount he remembers taking home. If the tax return later shows a different number, the benefit record can be adjusted. People with self-employment income should not estimate by looking only at deposits in the business bank account. Gross receipts, allowable expenses, net profit, and the timing of services can matter. Banking regulations add another layer. Banks are required to follow identity, fraud, and anti-money laundering rules. A bank may hold a suspicious check, restrict an account after signs of takeover, or ask for proof of the source of funds. A retiree may feel accused when a $48,000 cashier's check from a home sale is delayed. The bank may be applying a risk procedure. The safest response is documentation, closing statement, title records, account statements, and direct communication through official channels. Anger does not release a hold. Proof often does. Now we are ready for the last and most important cycle. The strongest danger is not a single notice, a single withdrawal, or a single bank change. It is the chain reaction created when several ordinary actions happen close together. Consider Daniel, age 66, who has not yet reached his full retirement age. He receives $2,300 per month from Social Security. He works part-time and originally estimates $20,000 of wages for 2026, below the $24,480 limit. His employer becomes short-staffed, and Daniel earns $38,480. That is $14,000 above the limit. Under the general earnings test formula, $7,000 of benefits may need to be withheld. Daniel does not update the estimate because he believes payroll reporting will handle it. In the same year, Daniel withdraws $65,000 from a traditional 401k to replace a roof and pay off a home equity loan. The withdrawal does not count as wages for the retirement earnings test, but it increases taxable income. More of his Social Security may become taxable. The higher tax return may affect Medicare premiums in a later year. He asks the plan to withhold only a small amount of federal tax because he needs the cash for the roof. Then Daniel changes banks after a fraud alert. He closes the old account quickly. The direct deposit update is delayed because identity verification is incomplete. One payment is rejected and returned. While trying to fix the missing payment, he overlooks an overpayment notice tied to the extra wages. 30 days pass. The system begins recovery. His regular benefit is reduced by 50%, from $2,300 to $1,150, while the bank issue is still being resolved. At tax time, Daniel discovers that withholding from the 401k distribution was not enough. He owes the IRS. His credit card balance has already grown because the roof cost more than expected. Later, when Medicare looks at the higher income tax year, his premium may increase. Each step was ordinary. Working extra shifts was ordinary. Fixing a roof was ordinary. Changing banks after fraud was reasonable. Missing one dense letter during a stressful month was human. But the systems do not see one human story. They see wage data, a taxable distribution, a bank account change, a notice date, and the absence of a formal response. This is happening quietly. On one screen, wages are matched. On another, the retirement account reports a distribution. On another, the IRS tax return records higher income. On another, Medicare uses earlier tax data to calculate a premium. On another, the bank's fraud system reviews the new account. On another, Social Security's collection record counts the days after the notice. There is no villain turning a large wheel. The wheel turns because each part follows its own rule. Here is the hidden rule that changes everything. A notice is not the end of a decision. It is the beginning of a deadline. The government may be required to tell you what it plans to do, but it is usually not required to build your defense for you. The agency does not automatically choose the most favorable argument. It does not automatically know that a one-time withdrawal came from a roof emergency. It does not automatically know that income fell after retirement. It does not automatically know that a wage report is wrong. It does not automatically know that taking half the benefit will leave no money for medication. You have to claim the protection that fits the facts. If you want to keep receiving calm explanations like this, consider subscribing to the channel and turning on notifications so you do not miss the next video. These rules change in small ways, and the people who hear about them early usually have more time to protect their money. If the amount is wrong, appeal. If the overpayment was not your fault and recovery would be unfair or unaffordable under the waiver rules, request a waiver. If you agree that money is owed but cannot survive the proposed withholding, request a lower recovery rate. If Medicare is using old income after a qualifying life-changing event, request a new determination with Form SSA 44. If tax withholding is wrong for your situation, review Form W4V and the entire tax picture. If work income changed, update the estimate. If direct deposit changed, confirm the new account through official channels. These are not magic words. They are separate protections for separate problems. Do not send every form simply because the form number was mentioned. The wrong filing can create more confusion. Read the notice. Identify the decision. Match the request to the decision. A reconsideration challenges the facts or law of the overpayment. A waiver addresses fault and fairness or hardship. A lower rate request addresses the monthly recovery amount. An IRMA request addresses an income-related Medicare premium after a qualifying event. A tax withholding election changes federal tax taken from the benefit. Precision is protection. The most practical defense is a retirement control file. It can be a paper folder, a secure digital folder, or both. Keep the current Social Security benefit letter, Medicare premium notice, latest tax return, recent pay stubs if still working, pension statements, retirement account distribution records, direct deposit confirmation, and copies of every appeal or request. Add a one-page summary with the gross monthly benefit, each deduction, the net deposit, and important deadlines. When a new notice arrives, compare it with the summary. A difference becomes visible immediately. Set 3 dates on the calendar after any serious notice: the date received, the 30-day action date, and the 60-day appeal date when applicable. Do not assume the agency will count from the day you finally opened the envelope. Do not wait for a family member to visit next month. Do not place it under a stack of medical bills. If you need help, contact the official agency, a qualified attorney, an accredited or authorized representative, a tax professional, or a local benefits counseling resource. Bring the notice and documents. Advice without the notice is guessing. Never alter or hide information. Protection does not come from moving money between accounts to make it invisible, using another person's name, or failing to report a required change. Banks and government systems may receive information later. A short-term attempt to avoid a rule can become a larger overpayment, tax problem, fraud allegation, or family dispute. The intelligent approach is to understand the rule, use lawful options, and document the truth. Do not allow fear to push you into paying a scammer. An official notice can be verified through the official account, telephone number, or office. A real debt process includes written information and rights. A criminal demands secrecy, speed, and an unusual payment method. No legitimate Social Security employee will tell you to buy gift cards, send cryptocurrency, mail cash, deliver gold, or transfer savings to a safe government wallet. The moment someone demands that, stop. Do not allow pride to keep you from asking for a lower recovery rate. A person who receives $2,000 per month and spends $450 on rent, $210 on Medicare, $180 on utilities, $120 on prescriptions, and $250 on food has already used more than the monthly benefit. Taking $1,000 for recovery is not realistic. Form SSA 634 exists because necessary living expenses matter. The agency will ask for financial details. That can feel intrusive. But the purpose is to evaluate whether the proposed amount leaves enough for basic needs. Do not assume a waiver is only for the very poor. Waiver decisions involve fault and whether recovery would defeat the purpose of the program or be against fairness and good conscience under the applicable rules. A middle-class retiree can face real hardship, especially with medical costs, housing, or a dependent spouse. This helps both lower-income retirees and comfortable middle-class retirees. Most people think they do not qualify, so they never ask. Nobody is going to tell you about this in the bank lobby. You have to claim it. At the same time, do not assume every overpayment will be waived. A waiver is not guaranteed. An appeal is not guaranteed. A lower rate is not guaranteed. Evidence matters. Timeliness matters. Accuracy matters. The goal is not to promise a result. The goal is to prevent a person from surrendering rights that exist. The 2026 retirement environment makes this discipline more important. Benefits rose 2.8%, but Medicare Part B costs also rose. Work limits changed with wages. Tax deductions changed for eligible seniors. Income thresholds affect Medicare. Retirement accounts remain a major source of taxable income. Banks continue strengthening identity controls. Federal debt collection processes have resumed in areas that were paused. Every change may look small by itself. Together, they can change the amount available each month. I want you to imagine the machinery one final time. Your employer closes payroll and sends wage records. Your retirement plan reports a distribution. Your bank processes the Social Security deposit and automatic bill payments. The IRS receives tax information. Medicare looks back at an earlier tax year. Social Security generates a notice. A computer assigns a date. 30 days begin to run. Nothing makes a loud sound. No alarm rings in the house. The envelope sits beside a grocery advertisement. That is the moment when years of savings can be protected or exposed. The strongest financial secret is not a hidden investment. It is not a special bank account. It is not a government giveaway. It is knowing which decisions are automatic and which protections are not. The deduction may be automatic after the deadline. The protection may require you to act. The income-based Medicare charge may be automatic from an old tax return. The reduction after retirement may require you to file Form SSA 44. The earnings information may eventually arrive automatically. Correcting the estimate early may require you to report it. The overpayment balance may appear automatically. A waiver will not file itself. That is the climax of this entire issue. The system is built to process information, not to understand your life unless you place your life into the record. The machine sees $38,480 of wages. You know that half of it came from emergency shifts. The machine sees a $65,000 retirement distribution. You know it replaced a leaking roof. The machine sees 2024 income. You know you retired in 2025. The machine sees no response by day 30. You know the notice was under hospital papers while your spouse was ill. Your story matters only when it is submitted through the procedure that allows it to matter. So act calmly. Read every page. Verify the notice. Mark the dates. Compare gross benefit with net deposit. Identify Medicare, tax, and recovery deductions separately. Gather proof. Use the right form. Confirm receipt. Follow up. Keep notes. Review the next payment. These actions are not dramatic, but they are powerful because they stop confusion from becoming financial damage. You worked too long to let a misunderstood letter control your retirement. You paid taxes, supported a family, survived recessions, rising prices, medical bills, and years when saving was difficult. The system may be complicated, but complication does not mean you are powerless. Knowledge gives you time. Records give you proof. The right request gives the agency a reason and a legal path to review what happened. Share this video with a spouse, a parent, a veteran, a retired coworker, or anyone who depends on Social Security. Do not send it to frighten them. Send it so they know that an official-looking reduction is not something to ignore and not something to handle in panic. A single conversation before the deadline can protect months of income. And if you believe this notice is important, watch the next video appearing on the screen now. In that video, I explain another quiet rule that can reduce the money retirees actually keep even when their gross Social Security benefit goes up. Understanding that rule may help you protect your income before the next tax return and Medicare notice create a surprise.